And let's take a small case study of a property that you just recently did, and maybe I hate to put you on the spot, but you know your numbers pretty inside out backwards. But let's take a peek into a case study of the Leduc place that you just purchased recently. Okay, and when did you guys put an offer? I know you and another person on this podcast, Michael Bug, was part of that as well, and you guys have done that. When did you put the first offer in? What did you buy it for? Tell us the story of the Leduc multifamily you just recently bought.
Sure. So around April of 21, I put in the offer based on what I thought, based on the rent roll, based on the expenses, without having seen the building. I mean, it had 4 vacancies at the time. They were asking $110,000 a unit. I put in an offer at 95. And I got the deal. So I got it under contract. I went and walked through the building. This was before, Mike was involved in the deal. I walked through with my property manager, and this is the most critical step of all. And he looked around and he said, Cory, you need to spend, I can't remember how much it was. It was something like $8,000 a unit to get to the market rent. And the market rent was actually lower than what I thought it was. And it was funny because he was there with the realtor, and the realtor's trying to tell us what the rents are. And, my manager's at Braden, he just looked around. He says, well, I manage this building, this building, this building, this building. And I can tell you that the rents are this, right? So, we based it on that. I went back and asked for reduction to $85,000 a unit. And I just got a flat out refusal. No. So the contract was collapsed. And this actually happened to me on previous deals too. It's like kind of discouraging, but at this point, I hadn't lost any money. This is 7 days after the purchase contract is signed. So you always want to walk through with your property manager as soon as you can after an offer, because this is the time to retrade the asset. This is the time to ask for a haircut if it's justified. And in this case, it was. So, the sellers were they responded, very negatively, but I left the door open. So 3 months later, they had it under contract again, and it had fallen apart again. So I think by this point, the deal had fallen apart maybe 5 or 6 times. So there's kind of a pattern going on here, right? So when they called me a second time, I was ready. So I said, okay, yeah, my offer still stands at 85. And we got it at 85. So that's how we ended up getting the building under contract at that price. So my PM had already walked through it. So, buying the building was very easy. We got a bridge loan. Rates were fairly low at the time. So it still made economic sense. So we did our renovations. I think it was 8 or 9 months later, we refinanced the building around $130 a door. So we were able to pull, I think, 90% of our equity, almost all of our equity out, despite, rates were already higher by the time we refinanced in July of 2022 of this year. So,
okay. So
pretty good deal.
Wow. So you bought the place. So let me just, my 6th grade Saskatchewan math is here. But I tell the joke, Cory, as I do have my grade 12 in Saskatchewan. I took grade 6 twice. Oh, hang on. Sorry, that's a joke, by the way. Okay. So you bought it for $85 a door. What kind of a renovation package? How much did you put into the property for a renovation per door on that units?
Yeah, so we budgeted $250,000. Now we didn't end up renovating all the units. So I think we ended up spending, about $180,000 to $200,000. And that's because, when you give rent increases, some tenants don't move out. So the best strategy to do this is we instantly renovated the units that were vacant. We did super high-end renovations. We extended the countertops. We put in a dishwasher. We actually made our 2 bedrooms larger, because we knew we couldn't compete with other 2 bedrooms because our 2 bedrooms were small. So we took a chunk of the hall and made our 2 bedrooms like a lot nicer and bigger. So we were able to get top rents there. So then what we ended up doing is we raised rents on, I think, 6 of the units at a time. But before that, we actually said, we gave them notices and we said, look, we want to spend, $5,000. We want to give you a brand new bathroom. Okay. And then, the tenants, they knew the rent increase was coming, right? But we did this first. We said, okay, we're going to do the bathroom reno. So then it wasn't a surprise when we asked for the full rent increase. It was like $150 a unit. So out of those, about half of them ended up leaving. So then we ended up doing full renovations on the ones that vacated. But the ones that didn't are today paying full market rent. So we're ending up with a building that was 18 units that I think probably 70% of the units have been upgraded, but the other haven't. But we have full market rent on all the units. So that's kind of how that went down.
Okay, so just so I'm following, so let's say in round numbers for me, 200,000 in a reno package. How many suites in that one again?
It was 17, but we were planning to do a bachelor conversion of the storage room because the storage room was big enough. So it was going to be 18 units. So I think we had budgeted 250 in total, but I think we were just under that. I think we spent around 200. So, divide that by 17 units.
So
like
that's
12,000 a door or something. I'm not sure.
Yeah, just under 11 and change. Okay, so you bought the properties for 85,000. You added $11,000, ballpark number. So you're into it for 96 a door. And you said you got it appraised. You got refinanced at 130 a door. 130 a door. So that's you raised the value of each unit by $34,000 just by doing that there on a residential appraisal type of a model and stuff like that, because as we know in multifamily, it's based upon the NOI and the income you generate and all that kind of stuff. But at the same time, that's a good investment of that $11,000 if you can get a $34,000 lift on just valuations, right? So
and a good point on that is I always say you need 2 for 1, right? So a lot of people will buy a building at 110 a door, to get an end value of 120 a door, and then spend 10 to get there. Right. But you need something for your pain and suffering, right? Like you need to get compensated for that. And the other piece to that too is there was the bridge financing that we had to use. So that added, I think it was another $80,000 to the cost as well. Right. So you have to factor that in, as well as, you have to duplicate an appraisal. We didn't have to redo a phase 1, but we had to do another building condition report. When you do a refinance, it's like a whole new purchase. So you have to add all those fees in as well. So if you're doing a BRRRR or a value add like this, you need to get the building at a substantially low price for this approach to make sense. Yeah. Especially today with the interest rates we're in. Like we have another building under contract right now, and this option is completely off the table just due to the changing lending environment.
Yeah. So in essence, that $11,000, that was just hard costs of the renovation that you put in, not including a lot of the soft costs and some holding costs and vacancy costs. So that $11,000 renovation could be upwards of almost $18,000, $20,000 per door on a total cost in package, right? So you're now into it for 105 as opposed to buying it for 105 and then having to do that work.
Yeah. Exactly.
Okay.
So if we would have paid full market price, we would have basically made nothing. Would have even cost us money. We wouldn't even have been able to refinance our equity out. Yeah.
And you also wouldn't have had any money able to do the renovation work to be able to raise the rents, to be able to get the higher valuation. Or else you'd have to be going into the old cookie jar that's buried out in the backyard and, sometimes throwing good money after bad's not the answer too. Have the asset.
No, you don't want to get in that situation. Definitely.
Yeah. have the asset pay for the renovation, right? If you will. So, okay. So you then got a new valuation. Talk to me about how does a refi in this, how does a refi kind of work? So you got the rents up, then you went and made a new application. You went CMHC. Talk to me about the refi, and then we'll complete the bow on this one purchase.
Yeah. So when we refinanced at the time, the MLI Select, which was the affordable housing program, was really picking up steam. It was kind of the flavor of the year. Everybody was doing it. We were kind of told that, why wouldn't you want to do this? There's, you can borrow way more money. The debt coverage ratio is lower. But the process was, as soon as we received a stable rent roll that met our target. So we had a target going in. I think we wanted to get to like 1,100 on rents. We ended up getting a little bit higher than that. But we weren't able to do that suite conversion. The city of Leduc put the brakes on this conversion, and we're actually still fighting this. We're actually taking this up in, legal mechanisms to try to get them to approve this application, because it's like an $800 net income, $800 per month times 12 months capped out is a lot of value, right? That we're leaving behind by not having this bachelor suite. But thankfully, we were able to raise the rents higher on the other units to make up for that rent that we didn't get. So as soon as we reached the target rent roll, I think it was something like 22,000 or whatever it was. We instantly reached out to our broker. We said, okay, we're at target, because we want to pay out the bridge loan as soon as we can. We're paying massive interest rates on that every month. It's interest only. If we go to the 12-month, there's a reset rate. So we're going to end up paying a higher rate. And then, things just don't go well if you take a BRRRR beyond 12 months. So we were very motivated to get that done. It was in the middle of summer. We did that. We got the approval fairly quickly. And when we were doing it, rates were around 2%. And over the 30-day period is when we had that massive spike, and interest rates went from like 2 up to like 4.5. So there was a lot of sweating bullets. We were like, man, we got to get this locked. We got to get this locked. We actually ended up having to pay down. It was called a pay down rate. So we had to pay $60,000 to get a rate of 3.5. And then the Bank of Canada bond just continued to go from there. So it was really a bit of a timing thing. But that's kind of the nuts and the bolts of how the refinance went. At the end of the day, it was good. We got the money we wanted out of it, but we didn't get the rate we wanted. And,
Right.
with these roller coaster rates, a lot of investors are going through the same thing with refinances right now.
Yeah. Okay. Now, there's a couple things there, some questions I want to ask in there as well, and it's just for education purposes here. Okay. So now someone's in there going, well, why is it important that you maybe want to get that bachelor unit, and you kind of rattled off $800 a month in rent, and that's pretty true net. Like you're not adding a lot more to the cost of it. If you have 18 units versus 17 units, the cost is razor thin marginally. So 800 times 12, right, is what you would do. Times 12 would be just, let's call it 9,600. Now, then what's the calculation to determine what the building valuation would go up? Do you take that, let's call it 9,000, let's say. How do you calculate the valuation lift on that by doing that?
So you just divide that number. So let's say it's 9,000 divided by the prevailing cap rate. So at the time, it's probably 5.5%. So, I mean, if you have your calculator there, you can do that for me. But basically, for every dollar of rent, you increase the value of your building by $200.
Right.
Is kind of the rough calculation.
Okay, so does this sound right? So if I did that calculation, by adding that other unit at $800 a month, there's just shy of $164,000 in building lift.
Yeah, exactly. So $800 times 200. That's the rule of 200, right? Gives you 160 grand. So that's on one unit. Right. So the lift, the multiplier effect. I mean, this is why we do multifamily as investors, especially when you look at right now in Alberta. And I believe, there's going to be a $200-$300 rental lift in the next 3 years. A lot of people think I'm crazy for predicting that. I'm not going to lock myself into MLI Select rent control, because I think I can get hundreds of thousands of dollars in upside in the next 3 years. We're just recapturing our losses from 2014, Russ.
That's right.
So I think the investors who've had patience have taken their licks like you and I have. We're still in there. Now it's time. I hate to say this, but as landlords, it's time to be greedy. Well, right? We've been on the other end of the stick for so long.
Here's the way I reframe it. I had lunch with a good friend of both of ours, not going to mention his name because he likes to be under the radar. And he just said, he goes, you know what? I've taken enough kicks in the you-know-where over the past decade. It's about high time these properties are going to start paying me now for all this pain and suffering I've gone through. And sometimes you just need to have a PhD. And I call PhD as a pig-headed determination with this kind of stuff too. And just at the end of the race, if you're the last one at the end, that's what's the most important thing as well. Hey, that was a lot of fun. Sure hope you enjoyed this segment from a recent podcast episode. Only a couple simple next steps from here. Number one, down here will be a link to subscribe so you don't miss any more episodes. And if you're interested in watching more segments from the podcast, click up here. And if you'd like to watch the full episode, there's a playlist for you down here. So enjoy.